Sukuk vs Bonds. What's unique about risk sharing? Have you ever wondered how sukuk and bonds differ when it comes to sharing risks? This question opens up a fascinating discussion about the core principles of Islamic finance. Let's break it down. Sukuk representing ownership in tangible assets, projects, or business ventures. Unlike conventional bonds, which are simply debt obligations, sukuk holders have a proportional share in the underlying asset. This means that the returns sukuk holders receive depend on the actual performance of the asset or project. If the asset does well, investors enjoy profits. However, if it underperforms, returns may be lower or delayed. This structure aligns with Islamic finance principles, where profits must relate to real economic activity and risk, steering clear of guaranteed interest, which is not allowed under Sharia law. On the other hand, conventional bonds are a different story. They representing a debt obligation where the bondholder lends money to the issuer. In this case, the bondholder receives fixed interest payments, regardless of how the issuer performs financially. Here, the issuer bears the risk of the project, while the bondholder has a right to fixed returns and repayment, irrespective of the asset's success. The sukuk issuance process is quite interesting. It involves creating a special purpose vehicle that holds the underlying assets. These assets can either be transferred to the special purpose vehicle, known as asset-backed sukuk, or they may remain with the originator, which is referred to as asset-based sukuk. Investors earn returns from the profits generated by these assets, sharing the risk because they are directly exposed to the asset's performance, not just the credit risk of the issuer. Several sukuk structures illustrate this risk-sharing concept. For instance, Ijarah sukuk involves leasing, where investors own the leased asset and receive rental income based on the asset's use and profitability. Then there is Musharakah sukuk, which is a partnership model where investors share profits and losses from a joint business venture proportionally. Another structure is Murabaha sukuk, where the issuer sells an asset to investors at a marked-up price, with payments structured over time. This model focuses more on cost recovery than profit sharing. From the perspective of Islamic finance rules, this risk-sharing model promotes ethical compliance by avoiding interest and encouraging fairness. It links returns to real economic activity, promoting transparency and accountability since investors have a direct stake in the underlying assets or ventures. In practice, sukuk issuance supports asset-backed financing and infrastructure projects while adhering to Sharia principles. It also provides an alternative for investors seeking Sharia-compliant investments that share both risks and rewards, contrasting sharply with the fixed-income nature of conventional bonds. Understanding these differences can help investors make informed decisions in the evolving sukuk market and trends.